Let's shift gears a little bit and talk about sort of the specific environment we find ourselves in today. I wanted to remind our viewers and our audience that Scott, the last time they heard from you was at the end of 2011 in an address. And at that time, you talked about how you and the team were thinking and positioned going into 2012. And you specifically talked about some of the bigger risks on the horizon. You thought a lot about the U.S. and whether the economic momentum was real or sustainable. You talked a little bit about the slowdown in China, and you talked a lot about Europe. And frankly, all three of those things have played out kind of how you were positioned in your thinking. What about today? I mean, obviously we can start with Europe and say the mess continues, and sort of how do you address where we sit today in the world?
Sure. It's funny that you reminded me of our conversation at the end of 2011, because in just finishing writing our quarterly commentary, it really does feel like deja vu every time I write the commentary of what should investors worry about. First and foremost, it's Europe, the slowdown in the U.S., and now probably increasingly the slowdown in China. So you're exactly right. For Europe, the mess does continue, and the reality is there's too much debt and there's not enough growth. And adding more debt to the situation by lending to Spain or the other indebted countries doesn't really fix the problem. I think ultimately we're going to have to see a situation where there's either some sort of default, debt forgiveness, or restructuring. It's really difficult to see how they come to a solution otherwise. And while we don't need to, based on our process, place a bet on which one of those happens and exactly when, we are getting to the point where sometime in the next several months we're going to get closer to some kind of resolution to the environment. I think kicking the can down the road has met its logical end.
Suggesting that Europe is a mess and continues to struggle doesn't necessarily translate into the fact that you avoid European equity in the portfolio, though.
No, that's exactly right. Probably the first response to that is, set against all the issues that Europe has, Europe is incredibly cheap. It's at close to valuation levels that prevailed in the early 1980s and preceded a long bull market in equities. So one should have some exposure to Europe, and at some point in the future, having an increased exposure to Europe will be a really fantastic investment opportunity. The question for us is weighing out that valuation opportunity with the other factors we consider, like the economic environment, as well as the price trend and price momentum that we think about.
Gentlemen, do you have any comments on sort of where we sit today? I mean, we could address the U.S. and it seems exceedingly that we're seeing data that suggests things are slowing. How does that populate your thinking and ultimately populate how the portfolio is built?
Well, the key drivers in our strategy, certainly, as Scott pointed out, for equity markets in general, we're focused on valuation, and so that's going to play an important role in the portfolio. But then, to the extent that we look at factors that fall more in, where are we in the current economic cycle, or even the price trends that drive individual assets, those elements taken together is what's going to really set our positioning. Currently within the portfolios, our exposure to equities is pretty neutral. There's still, opportunity, I think, going forward. But for the U.S. in particular, probably the biggest challenge is going to be we're heading into our election cycle, and there's going to be a lot of volatility in the markets likely to come about based on how that process plays out between now and November. So for us, the ability to kind of adapt on a monthly basis to how the markets behave is really critical. And I guess I don't anticipate that this summer will be a lot different from the last couple of summers, where there'll be kind of continued volatility, and we'll need to be nimble enough to adapt in those environments.
Which in effect makes it even more important to focus on balancing the risk and making sure that you have exposure to these different kinds of assets. The environment we faced over the last 12 years is very different than the one that we faced from 1981 to 2000, where all you had to do was buy equities and you had a great portfolio. Mm-hmm. Well, that game is over. And what we have to do now is really focus on the risk that's in the portfolio, where it's coming from, and making sure that it's balanced. Because if we take a valuation-only approach to investing in the portfolio, we're likely to get ourselves into trouble, because valuation is such a a concept that has a long time frame associated with it. So it's very easy to identify, for example, that equities are cheap today and bonds are expensive. The problem is, how long is it going to take for that misvaluation to correct itself?
Right. And I think one point that both Scott and Mark made that's worth highlighting is that we don't feel like we have to take a 18-month view and position the portfolio that way and not adjust it. We think that taking views like that are very, very dangerous, because then if you're wrong, you're going to be wrong for a very long time. So having a much more adaptive portfolio where we're willing to review a large swath of information, the models incorporate that, and then make adjustments on a monthly basis so that when the facts change, that the portfolio is going to change as well.
That whole idea of balancing risk is so critical to the essence of Intactive. And ultimately, is it fair to say that this is about trying to smooth out the return profiles of the portfolio? And I mean, it appears that one of the biggest challenges investors face today is just stomaching the volatility that they've been through for the last number of years. And is that a fair comment, that ultimately we're trying to smooth out the return patterns of the portfolio?
Well, sure. And there are probably two benefits. One is mathematical and the other is psychological. Mathematically, if you have less downside volatility in the portfolio, you'll end up with higher compound returns. From a psychological perspective, it's just as important, because it's those large losses that oftentimes prompt people to shift their asset allocation at exactly the wrong time, so that they fully participate in the downside and then don't participate in the upside. Therefore, taking an approach that does try to mitigate some of that downside exposure, but still have strong participation in the good times, we think is really a winning strategy on both fronts.
So from a psychological perspective, that's an interesting comment, that just the ability to stay invested might in fact be one of the primary drivers of actually defining whether you're successful or not.
That's right.
Gentlemen, any closing thoughts you'd like to make in terms of sort of where we find ourselves today, or Intactive portfolios and how we're structured before we say goodbye?
I think the key idea, whether it's with Intactive or within investors' broader portfolios, the notion of trying to think about how assets will behave in different kinds of environments is such a crucial idea. If you think about your government bonds, how are they going to behave if you go through a recession or a crisis? How will they behave if you go through a roaring period of growth? Same thing for equities and other assets in the portfolio. Really try to think through what that exposure is and how much risk you have. And I think probably one of the closing thoughts that starts with where we began was in bonds. Really don't just take a holistic, the Dex Universe bonds is the only way to think about bonds. It's really important to break that up. Dex Universe bonds have relatively low duration and therefore won't offer the same degree of recession protection as, say, long-term government debt. So in our view, really trying to segment that exposure and, again, think about how each of those assets will perform in different environments is really the right way to think about the portfolio. And step number one, whether those investors invest in Intactive, we certainly hope they will, but even if they don't, getting the idea of having those economic diversification is really the right way to go.
Gentlemen, any final thoughts before we say goodbye?
Well, I would say the only thing I would add, and as it relates to our process, is forecasting the future is very difficult, and so building a portfolio that has that strategic allocation that provides that economic diversification as a starting point is very important. And then, as I think we've learned over the last few years, the markets can be volatile. They can move very quickly and very significantly in different directions. And so having that adaptability is important as well. But if you're going to stay the course over time, having that solid foundation is really critical.
I think that what Scott and Mark have both said, in a sense, is that it's very difficult to forecast returns. And as investors, what we do is take a cash investment and invest it in assets that have risk associated with them. And because we don't know what the returns of those assets are going to be, it's best to focus on the risk. So we have to understand where that risk is, how much of it we have, and how we've allocated that risk, rather than focusing on what are the return expectations necessarily for each of these assets.
With that, I just want to thank all three of you for taking the time today, sharing not only the broad philosophy around how the Invesco Intactive portfolios are being managed, but also shedding some light on the current environment, which continues to be cloudy, would perhaps be a fair word to describe it, and just the importance of bringing that pragmatic approach seeking balance in the portfolio, and ultimately thank all of you for the commitment you've shown to Canadian investors and the job that you've been able to do for us. So thank you very much, and thanks for joining us.
Thank you.